class. Welcome to our discussion of Chapter 3, the accounting cycle. So this is actually where we are going to jump into some of those debit and credit rules that you've heard us talk about a little bit in this class. And this is really going to lay the foundation, technically speaking, for a lot of what we'll be doing for the rest of this class. So the focus of this chapter is going to be on the accounting cycle. So remember, we briefly talked about accounting records in Chapter 1. What are they used for? What makes them something that's useful to those compiling the information, right? What are they actually going to be useful for? So one of the things that we use accounting records for is to prepare financial statements. And we've seen some of that in Chapter 2, right? We're working on, in Chapter 2, on the preparation of financial statements. If you've jumped into Chapter 2 homework, you're already using accounting records to prepare those financial statements. Another thing is to complete income tax returns. So when it comes to completing a company's income tax return, the balance sheet, the income statement, all of the relevant transactions, all of that information is used to complete the income tax returns. That's not the focus of this class, but just know that all of these records that we're working with and going to be looking at are also relevant when it comes to tax. Okay? And they also will be used to create other reports. Okay, other financial reports. So the accounting records are going to be very, very important when it comes to actually applying and using the accounting cycle. We can't go through the accounting cycle without the use of accounting records. Okay, so what are the steps of the accounting cycle? These are something you want to make sure you make note of, put a star next to, whatever you need to do, because these steps are very important. So step 1 is to journalize, or in other words, record transactions. So in Chapter 2, we were recording transactions, but just using the accounting equation, right? Increases or decreases. In this chapter, we're actually going to learn how to actually journalize those transactions. Step 2 is you post each journal entry to the ledger accounts, and all of this we'll get into. After you do that, you can prepare a trial balance. Prepare trial balance. And then after that, which now we're getting into Chapter 4 stuff, which we won't get into detail now, we'll do that in Chapter 4, but next step is to make end of period adjustments. Or specifically, adjusting entries. And after you've completed those entries, you can move on to step 5, which is prepare the adjusted trial balance. So once you've prepared the adjusted trial balance, you finally have all the information you need to finally prepare your financial statements. Okay? And then, as we'll see in Chapter 5, the next step would be to journalize and post your closing entries. And then 8 is we prepare an after closing trial balance. So in a nutshell, those are the steps of our accounting cycle. Once we finish chapter 5, we will have learned how to go from step 1 all the way through step 8 successfully. 1, 2, and 3 we'll be able to see within this chapter. 4 and 5 is covered in chapter 4 and also 6. And then the last 2 steps will be covered in chapter 5. Okay, so this accounting cycle, although it seems daunting now, we're going to go through all those steps and figure out how to do all of that. But that's why, like I said, the foundational knowledge of these first 3 chapters is going to prove very helpful and very important. Okay, so what is the role of those accounting records that we talked about? Right? What is the role of accounting records? What makes them important? Well, managers and employees, they often use accounting records to establish accountability for assets or transactions that are under someone's control in particular, or to keep track of routine business activities, right? We need record of these things. Or if we want detailed information about a specific transaction, right? Or if we want to evaluate the efficiency and performance of different parts of our business. As you'll see later on, we can use those financial statements to calculate some financial ratios and see how well the company's doing. And overall, it serves as documentary evidence of what a company's been doing, right? Including whether it's been staying within compliance and following regulations, especially when it comes to taxes, right? Because there are certain rules that need to be followed with that as well. All right, moving on. So there's this thing called a ledger. Okay, there's a ledger account, okay, and then just an overall ledger, okay, which there are the different ledger accounts overall make up the ledger. Okay, so a ledger account, when we're talking about a ledger account, this is the record that we use to keep track of increases and decreases for a specific financial statement item. Okay, so it's ledger account is one name, or just overall account. If we're just talking about an account, this is what we're talking about. Okay, so this is a record that is used to keep track of increases and decreases in a financial statement item. So what's a financial statement item? That's anything that you'll find on an income statement, a balance sheet. Statement of cash flows is just cash, right? So any item that you'll find on a financial statement. So is there a cash account? Yes, there is. Is there a building account? Most likely. What about revenue account or expense accounts? There's an account for every item that you'll find on a financial statement, and the account is just how we keep track of how much of that very thing there is, and how we keep track of how that thing is going, increasing and decreasing over time. So the cash account, that's what we use to record increases to cash and decreases to cash. But we can also at any point in time go look at that account to see how much there is in that account. So when asked what an account is, it's simply just the record of a specific financial statement item and how it might have been going up and down as the period goes on. So each account has different elements. Okay, it has 3 elements. So let's just write out here account elements. So first of all, it needs to have a title. Otherwise, you don't know what the heck it refers to, right? So if we're talking about the cash account, the title is cash. Second, each account has a left side, and that left side is your debit side, and it also has a right side, and that right side is what we call our credit side. Okay? And how we show that an account is going up or down will depend on what kind of account it is. And that whether what a debit or credit represents will depend on what kind of account it is that we're talking about. And visually, on paper at least, what do these accounts look like if we're trying to, work things out? It looks like a huge T. The title goes at the top. The left side, like we said, is our debit side, and the right side is our credit side. So we didn't actually write debit and credit there, but that's just what they're called, debit side and the credit side. So anytime you debit an account, it's done on the left side. Anytime you credit an account, it's done on the right side. So anytime, let's assume, for example, we're looking at the cash account. If we're talking about the balance in an account, the balance is simply the difference between the debit and credit entries in the account on each side. So the balance is simply the difference between the debit and credit entries. So for example, and we'll go into the rules in a second, but for example, if I'm looking at cash and on January 1, I had a beginning balance of $10,000. Okay, I would show that as follows. We'll get into why in a second. But what if I debited the account, meaning put extra on the left, debited the account for $1,000 on January 2nd? All of a sudden now I have $11,000 as my balance because I'm adding together all the debits and credits, and there's only 2 debits here. That would mean I have an $11,000 balance. But what happens as soon as I credit the account, let's say for $5,000? Crediting the cash account means I'm decreasing it, and again, we'll get into that in a second, but just to show you guys the idea of what a balance means. A balance is what's left over in the account, essentially. So I initially had $11,000 on the left, and now I've credited or decreased the account with $5,000 on the right, or the credit side. That means I have $6,000 left, and that $6,000 is my balance. And wherever that balance lies, if it lies on the left-hand side, that means I have a debit balance. And if it lies on the right-hand side, it means I have a credit balance. But really, the main idea I want you to get from what I just said there is what a balance refers to, because those numbers probably don't mean much to you at this moment in time. We'll get into that in a second. Okay, so the balance of an account is simply the difference between the debit and credit entries. Okay? In our cash account, because it's an asset, it's going to follow certain rules as opposed to liability or owner's equity accounts. Okay? And the balance of an account. Okay? The balance of an account is what goes on the financial statements. So the balance, if we're talking about assets, any asset accounts, any liability accounts, and owner's equity accounts, these account balances, their balances are what we see on the balance sheet. Basically, okay, this is what's left in these accounts, and that's what goes on the balance sheet. Because remember, the balance sheet is that snapshot, right? That's supposed to be a camera. That's a snapshot of what the balances are on those accounts at a specific point in time. Okay, so let's get into a little bit of those rules. So, assets. accounts, if you want to increase an asset account, and I'll draw a T account here. We'll just title it with asset, but you'll never title a T account with asset because you want to talk about the specific asset. But when I increase, if I want to increase an asset, that is done with a debit. I'm going to just call this account. Left side is the debit side, right side is the credit side. So if I increase an asset with a debit, is that done on the left or on the right? The debit side is on the left side. So assets are increased with a debit on the left. Okay. Well, then what about a decrease? What if I want to decrease an asset? Then the opposite has to happen. If I increase assets with a debit, then I must decrease assets with a credit. So decreases to assets are done by crediting the account or putting that decrease on the right hand side. An asset should normally have a debit balance. Okay, that's just normal. Normally assets will have debit balances. Okay, and when we look at this accounting equation, these rules apply. So assets, they're on the left side of the balance sheet and the left side of the accounting equation. So they're going to follow this rule, that increases are with debits and decreases are with credits. Essentially, if we look at this T account, increase, decrease. So if assets are on the left-hand side, what about the right-hand side of this equation? So how would we figure out the rule for the right-hand side, for liabilities and owner's equity? Well, there's good news about these rules. The thing is, if you can memorize the rule for assets, you already have the rule for liabilities and owner's equity memorized because they're just simply the opposite. Liability accounts, to increase them. To increase a liability account, you do that with a credit. Same thing with owner's equity, because they're on the same side. And to decrease a liability account, you do that with a debit. Also the same thing with owner's equity. So increases happen on the right-hand side of the T account with a credit, but decreases happen on the left-hand side with a debit. Their normal balances are credit balances on the right-hand side. So let's summarize what we just talked about. And by the way, that accounting cheat sheet, which summarizes a lot of this and more, is under the Chapter 3 module. So make sure you refer to that. So what's the debit credit rule summary? We have asset accounts, and then liability and owner's equity accounts. What's the summary for those? Well, what's the normal balance for an asset account and then for a liability account? Okay, well, the normal balance for an asset account is a debit balance, which is the left-hand side of the account, whereas the normal balance for liability and equity accounts is a credit balance, which is on the right-hand side. How do I increase, therefore, an asset account? An increase is done with a debit on the left, and a decrease is done with a credit on the right. And then it's just the opposite here. How do you show an increase to this account? for one of these accounts, liability owner's equity, with a credit, which is on the right, and you show a decrease with a debit, which is on the left. Okay, so that's our summary for the debit and credit rules. And now we're going to learn about how to journalize. We're going to be employing a double entry accounting system or accounting approach. Okay. When we look at the accounting equation, assets normally have what kind of balances? Debit balances. So the debits on the left, or the debit balances on the left, need to equal out with your credits on the right, or your credit balances. So when we journalize, you're going to have to follow this rule. My debits need to equal my credits if I want to be in balance for a specific entry and for the entire accounting equation and the entire balance sheet. So that's a golden rule here. Not only are these debits and credit rules very important up here that we looked at, but debits have to equal your credits when we are journalizing. Even though we haven't journalized yet together, just remember that rule. All right. Next up, the journal. Okay, what the heck is a journal? So when we gather information, accounting information, and we initially record it by journalizing, this is done within the accounting journal. Okay, so it's basically a chronological record of all a company's business transactions. So when we engage in a transaction or there's a new transaction, we journalize it in the journal, and then later it's transferred from the journal to the ledger. Okay, so we don't do that with every entry necessarily. Usually, practically speaking, you wait until it's convenient to transfer a bunch of entries to the ledger, but it can also be done immediately. And once these entries are moved to the ledgers, remember the ledger has all of the accounts, like cash, building, accounts payable. The ledger has the balance of all of these accounts in the ledger, and that's what we use to set up our financial statements. But even to get to that point, we need to journalize those transactions in the journal first, transfer them to the ledger, and then we can eventually create those financial statements. So that was pretty much an overview. In the next video, we'll get into some transactions and actually see how we can apply these rules to actually journalize these transactions and make sure that we're following those rules correctly and making sure that that accounting equation stays in balance.